We're now joined by V Ramachandran, who is the Director and Chief Operating Officer of VGA, to talk more about earnings. Good morning, Mr. Ramachandran. Thank you for joining us on ET Now. And this was the second year that the summer season sales have been impacted. How is the demand trend actually seen post the second wave of COVID-19, and how is the recovery also shaping up for your company?
The market closes have been shorter in second wave compared to first wave, and we could operate in the market to some degree even through the month of May in some parts, because the onset was different across different parts of the country. Having said that, we are a company with strong presence in south and east. These two markets account for about 75% of our revenue. And these are also markets which are more significantly impacted. So the recovery in these places have been slower compared to the rest of the country.
Mr. Ramachandran, I think a lot of people are trying to gauge this. What is your expectation for the festive season, and therefore, what are your expectations for sales in the coming quarters?
So I think we are expecting to recover in the next quarter. The shortfall that we have had in the previous quarter. We are hoping that the markets in south and east will recover, and which is what we are observing through June and more particularly July. So we are hopeful that we will be able to press with better recovery in the coming quarters, and we hope to cover at least significant part of the ground that we have lost in the previous quarter. That being said, I think we will have to watch out for how COVID is progressing, and what interventions are being taken by governments and local administration in the geographies that we are in. And the impact of that on consumption as well as on our ability to cover the markets. As far as festive season is concerned, I think fundamentally, at this stage, our focus would be, very much, geared towards, recovering, the lost ground that we had in the previous quarter. And towards that end, we are focusing, very strongly on markets where we can expect a natural uplift because of the festive season.
Given the increase in the raw material costs, your margins are under pressure on a quarter-on-quarter basis. At what levels actually do you see your margins settling at now?
I think we have to separate two parts in the margin conversation. There is what I would call as material margin or gross margin, which is an indicator of the margin dilution or ability to maintain margin in the face of input cost increase. So material margin, for us, Q4 versus Q1 is more or less similar. So we have been able to maintain material margin. I think the EBITDA margin, right, has been lower, and the EBITDA margin has been lower because our volumes have been lower. Yeah, so I think on better volumes, we should be able to achieve higher EBITDA margins. So I think that's how I would read this. So at this stage, we have maintained margins compared with the trailing quarter, as far as the material margin or even the gross margin is concerned.
All right, let's talk about your electrical segment in particular. It accounts for about 45% of your sales, and obviously a very important category. One of your primary areas of focus is the real estate market. A lot of people are bullish on the space. Could you help us understand whether there's a significant recovery underway in the space?
No, I think broadly the electrical segment has been fine. I think some challenges are there in domestic wires because input cost increases are high. So maybe month to month or quarter to quarter, the timing of sale can sometimes shift. Typically, depending on whether depending on whether copper prices are moving up or moving down, trade tends to, stock up or deleverage. But, you leave that and look at the underlying. I think thus far the movement has been all right. As a company, our focus on the builder segment is, not as strong as some of our, larger competitors. And we are more focused on the retail segment in the electrical market. So to that extent, that's a beneficial impact on us. Our main challenge is fundamentally centered around the fact that, to the extent that, our business is indexed to South and East, right? There is a drag on volume recovery because these markets are slower to recover, and they got into the COVID also a bit later.
Could you talk about the excess inventory that is lying with you and the dealers? What is the inventory level that you're currently dealing with?
See, as a company, last year, we were impacted, by COVID. Our manufacturing operations were impacted. We were slower to start our factories compared to others, and we had some challenges in sourcing. Having noticed that, and having looked at the uncertainty that was associated with the COVID and the impact of that on the players in the value chain. We had consciously taken a decision to stock up, also to in anticipation of a strong summer this year. Given that last year's summer was muted, and a good part of our portfolio are summer-driven products, right? And so we felt that those who had not bought last summer cycle would come back this summer cycle. So we entered, I would say, we entered the summer season with very high inventory, and which was a conscious call that we had made. And we have been maintaining that inventory, and we are running that down through June and July, and maybe August, right? So we do believe it was good and timely that we had built that inventory, and it will support us now. Otherwise it's difficult for the supply chain to because these are being nowadays very tightly managed in professionally run companies. So the flexibility to step up and step down and address demand is challenging. So the inventory is helpful. As far as trade inventory is concerned, from what we have observed, based on the data that we are collecting from our trade channel, I think trade inventory is more or less normal, at least as far as our brand is concerned. And the company inventory is healthy, but I think it will normalize by next month, as the pent-up demand is fed by the inventory that we have on hand.
Mr. Ramachandran, thank you so much for taking the time. Wish you all the best for the future.